In this section, we're going to explore how we understand a firm's profitability under variable costing and absorption costing when that firm makes fewer units in a period than it sells. We're still looking at laser save, and none of the costs or the selling price has changed between November and December. The only difference is that in December, Laser Save recycled 800 cartridges, but it sold 1,000. Obviously, that wouldn't be possible, except that we already know that in November, the firm made more cartridges than it sold. So it had some 250 cartridges in its ending finished goods inventory at the end of November. Those units are available for sale in December. Let's look at absorption costing first. In December, the manufacturing costs will be $23 per unit variable manufacturing costs times the 800 units that the firm made, plus $20,000 of fixed manufacturing overhead, to give us the total manufacturing cost for the period. To find the manufacturing cost per unit, we divide the total manufacturing cost by the 800 units that the firm made, and we find that in December it cost the firm $48 per unit. Looking back at November, it cost the firm $39 per unit. That's very odd because nothing changed in the firm's cost structure. Not the fixed costs, not the variable cost per unit. When we compare these two numbers, we have to wonder, why was the manufacturing cost per unit higher in December than it was in November if nothing about the cost structure changed? So, you tell me, why did the manufacturing cost per unit increase in December compared to November? Answer A can't be right. Total variable manufacturing overhead can't increase in December. In fact, it should decrease because the total number of units made decreased. Answer B can't be right either, because total fixed manufacturing overhead is still $20,000 a month. And answer C can't be right, since the variable manufacturing overhead per unit is still $3. So the right answer is D. The fixed manufacturing overhead per unit must have increased. Let's see why. We just figured out that it cost us $48 per unit for manufacturing costs in December. We can multiply that by the 800 units that we made. That will give us the total manufacturing cost for the 800 units made in December. But we sold 1,000 units. So we can contribute the total manufacturing costs for the 800 units made in December, but we still need 200 more units and their associated cost. Those units must come from the finished goods inventory that was left at the end of November. In November, the units cost us $39 each, and we had 250 of them, so we can figure out the total value of our November ending inventory. We need 200 of those units. At $39 each, we can figure out the value of that inventory that we must have sold in December. Together, the cost of the units made in December plus the cost of the 200 units from November equals the total cost of goods sold for December. We can subtract the value of the 200 units that we must have sold from the total ending inventory from November to find the value of the ending inventory at the end of December. Now we can make an income statement under absorption costing for December. Sales revenue hasn't changed. It's still 1,000 units times $60 per unit. But cost of goods sold comes from two sources: 800 units at $48 each from December and 200 units at $39 each from November. Sales revenue minus cost of goods sold gives us gross profit. Now we can figure out our operating expenses. Variable selling and administrative is 1,000 units at $1.25 each. Fixed selling and administrative is $12,000. We can add those costs together and subtract the total operating expenses from the total gross profit to get the firm's operating income for December. Wow, that's a really small operating income. What happened? We're still selling 1,000 units. We're still selling those units for $60 each. Nothing has changed in our fixed costs per month or our variable costs per unit. Let's see if we can figure out why the company's operating income is so small in December. On the December balance sheet under absorption costing, our finished goods inventory is the 50 units that we still haven't sold times $39 per unit. That $39 includes the direct materials, direct labor, and variable overhead that are in those units, plus the allocated fixed manufacturing overhead for the 50 units. Now, let's look at operating income over the 3 months. In October, we sold all of the units that we made. Therefore, 100% of October's fixed overhead ended up as part of cost of goods sold in October, because each unit carried its share of the fixed manufacturing overhead onto the income statement. In November, we didn't sell all of the units that we made. The units that weren't sold carried their share of November fixed manufacturing overhead onto the balance sheet as part of the capitalized cost of the inventory. That means that in November, less than 100% of the monthly fixed manufacturing overhead was recognized on the income statement under absorption costing. In December, we sold more units than we made. That means that we recognized all of the December manufacturing overhead and part of the November manufacturing overhead as part of cost of goods sold. That's why operating income is so much lower in December. Now, you explain it to me. Why was operating income lower in December than in November under absorption costing? Obviously, answers C and D can't be right because the fixed manufacturing overhead was $20,000 in each month. Now let's look at answers A and B. Answer B says that some of the November fixed manufacturing overhead was capitalized on December's balance sheet. That's a true statement. But that capitalized fixed overhead from November is attached to the 50 units that remained unsold at the end of December. Therefore, that doesn't explain why operating income was lower in December than in November under absorption costing. The correct answer is some of November's fixed manufacturing overhead was expensed in December because the 200 units that we took out of ending inventory brought their November fixed overhead into December. That's why December's income was so low. Take a look at December's operations under variable costing. Variable manufacturing costs are still $23 per unit. Variable selling and administrative is still $1.25 per unit. On our income statement under variable costing for December, sales are still 1,000 units times $60 per unit. Variable costs include $23 of variable manufacturing costs times 1,000 units and $1.25 of variable selling and administrative costs times 1,000 units. We can add the variable costs together, subtract the total variable costs from sales revenue to get total contribution margin. Our fixed manufacturing costs are still $20,000. Our fixed selling and administrative costs are still $12,000. Add those costs together, subtract the total fixed costs from the contribution margin to get our operating income for December under variable costing. On the balance sheet in December under variable costing, our finished goods would still be 50 units, but they would be capitalized at $23 per unit. Only the variable direct materials, direct labor, and variable manufacturing overhead to get the total cost on the balance sheet. When we compare the operating income under variable costing over these 3 months, we see that it's the same in each month. That's because variable costing treats fixed manufacturing overhead as a period cost, not as a product cost. So 100% of the fixed manufacturing overhead is expensed in each period under variable costing. Now let's compare the two methods in December. We can see that operating income under absorption costing is much lower than under variable costing. We can also see that the value of finished goods on the balance sheet is higher under absorption costing than under variable costing. Let's see why this happened. Operating income is $3,200 greater in December under variable costing than under absorption costing. That $3,200 represents the 200 units from November that brought their $16 per unit of allocated fixed overhead onto the income statement under absorption costing in December. The value of finished goods under absorption costing is $800 higher than under variable costing. That difference comes from the $16 of fixed manufacturing overhead that each of those 50 units carries under absorption costing. Remember, absorption costing treats fixed overhead as a product cost. Variable costing treats it as a period cost. So, my question to you is, why is December's operating income less under absorption costing than under variable costing? Answer A can't be right. Variable costing recognized 100% of November's fixed overhead in November and recognized 100% of December's fixed overhead in December. Answer C can't be right either, because variable costing never capitalizes fixed overhead. It treats it as a period cost. Now let's look at answer B and answer D. Answer D is correct. Some of November's fixed manufacturing overhead was capitalized in December under absorption costing, but that's the part that didn't affect income. The correct answer is that some of November's fixed manufacturing overhead became part of cost of goods sold in December under absorption costing. That's the part that did make December's income so much lower.